Okay, this is our final week before our second exam. Kind of give you a quick update of where we've been and where we're going. We've already looked at in week 7 and 8 the sale of goods, introducing the cost of goods sold, and then we went into FIFO and LIFO. Last week we looked at current assets. This week we're going to jump into the bottom half of the assets, the long-term assets. So the first thing that I wanted to bring to your attention, when you buy PPE, this is a review of what we did back in about week 7. When you buy an asset like inventory, or in our case now, we're going to be talking about long-term assets, we include in the cost of those assets any cost that gets the item ready to use or sell. In our case, it'll be to use because we're talking about equipment. So that would include the sale price. We're going to be paying sales tax since we are the end user when it's equipment we're talking about. If there's any returns, or I should also put on here, or discounts that we receive, we're going to add in if we have any shipping that we have to pay for. And then installation, anything that gets the item ready to use, just like what we did with inventory. Okay, that's the first new little section, even though it's kind of a review. The second thing is more new, and it has to deal with the difference between a capital expenditure, and notice the word expenditure, not expense. So this is basically, what this is saying is I bought something big for the business, and I can't expense it, so I have to put it on my assets. So when we add something big to our assets, that's what this is going to be talking about, and we'll see that in just a second. So a capital expenditure, buying something big, versus an ordinary type repair that won't last us more than a year, that we need to do all the time. So the question is then, a capital expenditure would be adding something on to our already existing asset. That's what we're talking about here. So if you buy, and we'll see as an example in a second, a new engine for your car 5 years down the road, that's a big purchase. That engine will last you more than a year, you hope. So therefore, it can't be an expense if we think back to our expense rules. The expense rules say, are we using it now? And the answer is yes. And are we only using it right now for this year? And the answer would be no. So it cannot be an expense. So what we do, if the item that we bought increases the asset's life, which a new engine would, it only has to really do one of these 3 things, but the asset, when we buy a new engine, it will also increase the value of the car. Or it changes how the asset works, like having a hauling van and then transforming it into a passenger type van. That's changing how the asset is used. So if we answer yes to any one of these 3, what we're going to do is add that cost right into the equipment that I purchased. So for example, again, if I bought a new engine, if I already had on my books a vehicle worth $20,000, and I just bought a new asset, and I just bought a new engine for $2,500, I would actually debit the vehicle account. So real quickly again, if 2 years ago, we'll just make that up, 2 years ago, this was my journal entry, I bought a vehicle for $20,000, and I credited my cash, just throwing something out there. And then now I buy a new engine for my vehicle. I do not want to expense this because this item was going to last me longer than a year. What I want to do is put it right into the vehicle's account. And so now my vehicle is worth not $20,000, but $22,500. So again, when we purchase a new engine for the vehicle, I'll put that here, new engine. For the vehicle, we're going to actually debit our vehicle account. Here are a couple other examples of capital expenditures. These are by no means all of them. Putting a new engine in, maybe putting a new transmission in, that's a pretty big item for a vehicle. It's probably going to make it last longer. You change a van into, say, a security vehicle. You have a whole bunch of new stuff in there. If you have a building, you put on a new roof. That roof is going to last you a long time. We wouldn't want to expense that just in 1 year. So those are all types of items that I would add right into the actual asset cost. If the item that I purchased does not make it more valuable or change its useful life, it's just a normal wear and tear type expense, then I just expense it as I would any other expense. I might call it a vehicle expense or a maintenance expense. So, for example, having an oil change, maybe having a new paint job. If I'm in the business of hauling and I maybe drive at least 50,000 miles a year in a type of truck, new tires, that's going to be a normal wear and tear for me. I'm going to probably have new tires once a year. So that's not going to make my asset, definitely not make it worth more or increase its life. It's just going to be a normal wear and tear. Okay, the third thing, so we've talked about what gets included in the cost of an asset. If we buy something that adds on to the asset, do we put it actually right into the asset cost itself, or do we expense it? The third thing, before we get to the main area of this week, is I wanted to look at land. Land, the first thing that I want to show here, land does not depreciate. So when we start talking about depreciation, we will not look at land, because the theory is then that land should last forever. Even if you have buildings and you use the land, it's still going to be there 100 years from now just the same as it was. The other thing that I wanted to put include in with this land is going back to what we talked about first, including any costs to get that land ready to use. So if you buy new land and then you have to smooth it out and get all the stuff out of there, and you have to pay maybe somebody to do it, or you rent some machines, those kind of costs are going to get included right into your land account. And then if you have any further costs, that is going to get added in, like an attorney fee to get the paperwork done. That's going to be there as well. However, there is a difference between land and land improvements. Land improvements do depreciate, because these type of items will not last forever. And some examples is a parking lot, putting in a new parking lot, putting up a big fence around your perimeter, updating your landscape, putting in new trees and shrubbery. Those are expenses that the business incurs, but I don't want to expense it all in 1 year. That would be unfair to that year. I'm going to be using those trees for much longer than 1 year. So I will put them on as a long-term asset and then expense them over their useful life. Okay, now since we've just began to talk about depreciation, what we're going to do in this lecture, the first half of the lecture, is we're going to look at straight line depreciation, and we're going to look at then what happens when I sell an asset and I'm using straight line depreciation. The second video will focus on the last two methods of double declining in units of production for depreciation. For a straight line method, so this is by far the most popular method. I looked it up, and it's somewhere between 80 and 85% of businesses will use this method just because it's the easiest. A lot of times you only have to do a calculation once, unless you have one of those items that we talked about called a capital expenditure. Then really you only have to make a calculation one time, and then every single year you use the same number. It's a straight line method. So if we calculate $10,000 this year's depreciation, every single year is going to be $10,000 until the asset runs out and I've completely expensed it. So with straight line, we already know this first item that you have to have. We've already talked about that way back to week 2 and 3. You have to know the useful life. So management makes an estimate. That's all it is an estimate of how long they think they will use that asset. It could be used for a much longer, but that's not our concern as the company. We want to know how long we are going to use it, and that's going to be our estimate. The second term is a new term that we haven't looked at yet, And these are synonymous. It's kind of like dividends and drawings are the same meaning. Residual value and salvage value mean the same thing. What that is simply the approximate cost that management feels the asset is worth when they're done with it. So, for example, like Enterprise Rent-A-Car, they may only have their cars on their site for 3 years. Usually rent-a-car places have new cars all the time. Well, after 3 years, that car still has value. I would not want to depreciate that car down to zero, having a whole bunch of expenses up front, and then in the year I sell it, year 3, that car is worth zero, but I bring in, say, $8,000 for that vehicle. I just have now an $8,000 gain that we're going to talk about in a minute. And then so I have a whole lot of expenses, and then I offset it with gains. The best thing to do is to negate both of those out and say, well, what do I think it's going to be worth, and then only depreciate to that amount. Okay, so when we actually do the straight line depreciation, as you hopefully remember from weeks 2 and 3, it is very easy to do straight line. The only new thing is just simply taking out the salvage value amount from the asset's cost. So if our asset, say we bought something for $10,000 and we think it's going to be worth about $3,000 when it's time to get rid of it and sell it, I would actually deduct that $3,000 before figuring out my expense. So I would take the 10 minus the 3 and then take that $7,000 over, say it was 7 years to make it easy. It'd be a $1,000 expense. Instead of taking the actual cost, $10,000, and dividing it by 7 years, I want to take the 10 minus the 3. So here I have a little example. And what I would do at this point is pause the video and just write down some of the facts. And then I'm going to go through how we would journalize this for not only the purchase, I think I'll do the purchase, but for sure the depreciation and how we get the updated book values. So we bought a new car. One of the key things is it was bought and purchased in July of this year, of 2016. It cost $19,000 on the note. We estimate it has a salvage value of $4,000 and a useful life of 5 years. So again, if you need to pause, do so. And then I'm going to go through how we do this. Okay, so the first step, remember we find our depreciable cost. We take the actual cost minus our salvage value, and I got $15,000. Then you take whatever you just got, the $15,000, and divide it by our useful life. So that tells me that my yearly depreciation expense is $3,000 a year. And that would be if I had it for the entire year. But note up here, I bought it in July. I didn't have it for the whole year. I only had it for a half a year. So in 2016, my actual depreciation expense is really only $1,500, which then that is also my accumulated depreciation since I didn't have anything before this. And that leaves me with a book value of $17,500. Remember how you get book value? You take your actual cost, This $15,000, there is no journal entry for this. This is only for calculation purposes. That's it. Once I've used it for calculation purposes, then I pretend it's not there anymore. So to get the book value, I take my original cost, what's on my T account, $19,000, and subtract out the $1,500. So back in July, I would have debited the $19,000 to my vehicle, credited the note payable for $19,000, and now what I would have just done is, in the end of the first year, had a depreciation expense of $1,500 and an accumulated depreciation of $1,500. So let's put that journal entry in here now. For the end of the year, 12/31/16, I would have had a depreciation expense of $1,500, and I would have credited my accumulated depreciation for $1,500. Now, when I get down to the next year, in 2017, I've had the asset for the entire year. So I only need to depreciate it. Or I actually do need to depreciate the entire $3,000 that I calculated up here. So again, once I've already done this $3,000 calculation, I don't have to redo it until the very end. I'm going to take $3,000 every year, and then notice if you count them up, you'll see 1, 2, 3, 4, 5, 6 years. You think, well, wait, why is there 6 years when it's only a 5-year asset? Well, that's because this first year was only a half, and this last year is the other half. When I get all done with that final year, my book value should be the same as the salvage value if I did the calculations correctly. Okay, now let's we're going to look, okay, with the same example, we're going to look at, well, what happens if I do end up selling it? Maybe no matter really when it is. What's going to happen when I sell my equipment? Well, we still want to revert back to the 2 debit and credit questions that we learned back in week 1. Our debit question is, well, what did we get? Well, when we sell an asset, we're either going to get one of 2 things most likely. We're going to get cash or a promise to pay. Most likely it'll be a note. If it's a big asset, it's going to take them a while to pay it off. And then the credit question, why did we get it? Say it was cash. Well, I got it because I got rid of my equipment and I sold it. So I need to remove the equipment from my T accounts, as well as my connected accumulated depreciation account. So those 2 go together. When I get rid of one, I have to get rid of the other one. And then it's very often that what your asset is worth on your books, say up here, if I sold it after this first full year, it was worth $14,500. There's a good chance that I'm not going to sell it for $14,500. Maybe it'll be $14,800. Maybe it'll be $13,000. If that's the case and I don't sell it exactly for what it's worth on my books, I'm going to have a gain or a loss. A gain will be when I sell it for more than what it's worth on my books, and a loss when I sell it for less than what it's worth on my books. Gain and losses are treated very similar to how an expense will look, or I should say losses are treated like how an expense will look. Losses will have a debit balance just like all of the expenses. Gains will look like a revenue, even though they're not revenues, but they will look like it with an increase the normal balance on the credit side. But really the gain and losses are even beyond the revenue and expense areas when we look at the parent accounts on our T accounts. These are actually on out in the 600 accounts, which are accounts that don't happen very often. The first 5 up through revenue and expenses being the 5th one, those are accounts that happen all the time. The 600 accounts are the ones that don't happen very much, like a gain or a loss. It isn't in our normal business to sell our assets. That's not usually how we make money or possibly lose money. So let's look at an example with this gain or loss item. And we're going to go back up to my original example using the vehicle, a $19,000 vehicle. But we're going to assume now that at 9-30, so September 30th, 2018, I sell it for $11,000 cash. So my T accounts would be up to date through 2017. And now we're going to pretend now that I sold it in 2018. So my accumulated depreciation has an opening balance right now of $4,500. My vehicle cost $19,000. This is what I would want to have on my T accounts. Vehicle with a $19,000 debit. accumulated depreciation for the vehicle of $4,500 up to date through 2017. Now I need to go in and show the 2018 journal entries. I can't just jump right to the cell because I actually used the equipment for part of the 2018 year. I used it all the way up through September. And if I used it, I have to depreciate it for that amount of time. So I need to think then, if I have a $3,000 a year depreciation, how much am I going to depreciate if I only used it through September? Well, just like with the interest, if you add up the number of months out of a total year of 12 months, that's going to tell us how to do it. So if we take 3,000 times 9 months out of 12, which is 75%, that's where I get this $2,250 that I need to add in to my depreciation expense for 2018, and also add it into my accumulated depreciation. So 3,000 times 9/12 of a year. Now at this point I'm ready to do my actual sale. And I ask the two questions that I just did up here. What did the business get? We got money. We got cash. So I'm going to debit my cash. And I'll show you this formula in just a second. I got cash for $11,000. Why did I get the cash? Well, I sold this asset, so I need to credit $19,000 to my vehicle account. I also need to get rid of the accumulated depreciation that goes with it. So I had $4,500, but I just added in $2,250 to that account. So I need to get rid of both of these. Here's my credit to the vehicle. The vehicle needs to be off my books. A debit to my accumulated depreciation. Remember, it's a contra account, so to get rid of this asset, I need to debit it. And then, when I add up my two debits, I only have $17,750, which obviously does not equal the $19,000 credit. The difference is our brand new account called loss on disposal. And I actually want to use the on disposal part. It's just like saying you wouldn't want to just say rent as a journal entry. You want to say rent expense or prepaid rent. I want to specify exactly what happened here, a loss on disposal for $1,250. Now another way I could have found this $1,250 is by doing a little formula, a gain-loss formula. All you got to do, just like what my little formula here said, take your sale price less your updated book value, and you can easily get your book value. Just take your cost minus your accumulated depreciation up to date. And if I take these two, I do show a negative $1,250 when I subtract it out. Any negative amounts would be a loss. Okay, now for the final part of this lecture, what I want to do is an example. And I think at this point we will start a new video for the example on number 33.